Stop what you're doing. Seriously, if you own any biotech stocks, or you're even thinking about dipping your toes into this sector, you need to see this 5-model valuation breakdown right now. Because what if I told you that one specific diagnostics company just smashed its earnings so violently that it completely shattered its own long-term valuation narrative? Look, I totally get it. I know the biggest pain point for us retail investors right now. Biotech is notoriously, painfully volatile, right? And that fear of buying a stock right at its absolute peak or catching a falling knife, it keeps so many of us sitting safely on the sidelines. But listen to this. Last week, I sat down and ran Veracyte's Q1 2026 data through 5 distinct fundamental valuation models, plus 2 legendary investor checklists, specifically Warren Buffett's and Peter Lynch's. And honestly, what I found genuinely shocked me. According to the math, this stock's intrinsic value could actually be nearly 24% higher than its current trading price. That is a massive potential margin of safety. You really have to think of Veracyte not just as another medical lab running standard tests, but as a literal data mining gold rush happening right inside the oncology space. So here's the deal. By the end of this explainer, you are going to know exactly whether this stock is a screaming Buffett buy or a classic Lynch valuation trap. And more importantly, I promise you're going to walk away with a clear, actionable framework so you can evaluate these kinds of setups yourself. Let's get into it.
Okay, here's our roadmap for today. We're going to cover the Q1 earnings shock, the twin growth engines, their next revenue catalysts, the real-world clinical impact, and finally, we'll dive right into that valuation debate. Boom, 166%. Take a second to let that sink in. That is the massive year-over-year earnings increase Veracyte just dropped on the market for the trailing 12 months. They absolutely crushed their earnings per share forecast by 57%, bringing basic EPS up to 35 cents for the quarter. It's a huge signal. It proves they aren't just doing cool science, they are successfully translating complex genomic tests into serious, undeniable financial leverage. All right, Section 1, the Q1 earnings shock and how they are absolutely smashing expectations. So how exactly does a company go from developing niche diagnostic tests to generating this kind of explosive momentum? Well, it really boils down to 3 things: volume, execution, and pricing power. Look at this. Revenue jumped a whopping 21.5%, going from $114.5 million in Q1 2025 straight up to $139.1 million in Q1 2026. What's actually driving that bar higher? It's a 19% growth in physical test volume. That's roughly 45,200 tests processed, combined with a 3% bump in their average selling price, which now sits at $2,900 a pop. And because of that incredible scale, they managed to drag their net margin all the way up from a super slim 7.1% to a very, very healthy 16.2%. But the absolute standout figure here, that adjusted EBITDA, $42.8 million. That represents 30.8% of their revenue. Now, Veracyte had this long-term target of hitting 25%, and they just blew right past it like it was nothing. Plus, they generated over $35 million in operating cash flow, meaning they ended the quarter sitting on a massive $439 million in cash and short-term investments. This profitability profile is so ridiculously robust that management actually stepped up and raised their full-year revenue guidance to somewhere between $582 million and $592 million. But you know, numbers on a spreadsheet are really just the echo of real-world activity. So we have to ask, what exact engines are driving this massive clinical volume and actually generating these crazy results in doctors' offices all over the country? Let's move to Section 2, the twin growth engines, Decipher and Afirma.
Because Veracyte's current success, it isn't just built on some single lucky break. It's resting firmly on 2 foundational pillars. Here's the exact breakdown of that 45,200 testing volume from the quarter. First, you've got Decipher, which focuses on prostate cancer risk profiling. That accounted for roughly 28,000 tests. Then you have Afirma, which tackles the really complex diagnosis of thyroid nodules from a single biopsy. That brought in another 17,200 tests. These 2 specific tests are the absolute bedrock of the company's testing revenue, and that core revenue stream itself was up 26% year over year. It's a machine.
Let's zoom in on Decipher for a second. It saw an incredible 24% year-over-year volume growth. Even better, they saw nearly 30% growth in high-risk categories like metastatic disease. Why is it growing so fast? Well, Decipher has built this massive competitive moat using over a decade of clinical evidence. In fact, it's the only gene expression test out there to achieve Level 1B evidence status in the strict NCCN guidelines. And here's the crazy part.
The CEO pointed out that only about 1 in 3 US men with prostate cancer are currently getting the benefit of Decipher. That means 66% of their total addressable market is literally sitting there untouched. The runway left here is just massive. And then there's Afirma, which saw its own revenues jump by 21%. A huge driver for this was a major, behind-the-scenes operational upgrade. They transitioned to what they call their V2 transcriptome workflow. Now let me translate the science here for a second. This upgrade basically fixed their no-result rate. It means they're taking historically tricky, low-input RNA samples, stuff that used to just fail in the lab, and successfully converting them into definitive answers. This directly helps doctors rule out completely unnecessary thyroid surgeries for patients, and from a business standpoint, that single structural fix added a full 400 basis points to Afirma's volume growth in Q1. Just brilliant execution.
All right, Section 3, the next revenue catalysts, looking beyond the core.
So now we look to the future. And what's super fascinating here is that management actually excluded the potential revenue of their upcoming products from those raised 2026 projections we talked about. That means any success they have with these new launches, it's pure upside. But before we look at the timeline, let's quickly define two pieces of medical jargon so we're all on the same page. First is LDT, or Laboratory Developed Test. That's just a proprietary diagnostic test designed and used within one single lab. Second is MRD, which stands for minimal residual disease. That refers to the highly sensitive tracking of tiny amounts of cancer cells left in the body after treatment, which they usually detect via DNA floating in the bloodstream. Okay, keeping those in mind, here is the critical timeline. By mid-year 2026, Veracyte is targeting the commercial launch of their Prosigna LDT, which goes after a U.S. market of about 225,000 early-stage breast cancer patients. Crucially, in June 2026, massive data from their Phase 3 Optima trial is going to be presented at ASCO, which is the biggest oncology conference of the year. That data readout is going to be absolutely vital for Prosigna's adoption. Right alongside that, by the end of Q2 2026, they're launching True MRD, initially targeting recurrence monitoring in muscle-invasive bladder cancer. Guys, these are the two largest product catalysts for this company since Afirma was originally launched. The stakes are huge. Which leads us to Section 4, real-world clinical impact and data at scale. Because look, behind every single dollar of revenue and every flashy new product launch is an absolute mountain of genetic data, validating Veracyte's entire approach. And the sheer scale of this real-world impact was just put on full display at the AUA 2026 Urology Conference. They presented more than 15 different studies focused on the Decipher portfolio alone. The Decipher bladder and prostate tests, they're doing so much more than just predicting some generic high-low risk level. They are actively identifying highly unique molecular subtypes. For example, Decipher bladder actually helps clinicians understand a tumor's biology up front, identifying exactly which patients are most likely to respond perfectly to neoadjuvant chemoimmunotherapy. They are literally using genomics to guide real, boots-on-the-ground surgical decisions. It's life-changing stuff. And fueling all of this innovation is their proprietary Decipher Grid research database. Let me tell you, this is a massive competitive advantage. They have over 200,000 whole transcriptome profiles banked. What's more, they are actively scanning more than 350,000 historical patient slides to fully digitize them. By pairing those digital pathology images with their incredibly deep genetic data, they're unlocking some seriously advanced AI insights. This flywheel of continuous compounding data generation creates a moat that is going to be incredibly difficult, maybe even impossible for competitors to cross anytime soon. But this brings us to the core dilemma for us as investors, doesn't it? We see the soaring growth, we see the expanding margins, we see the seemingly unassailable clinical data. But at the end of the day, is the stock actually worth buying at its current levels? Let's dive into Section 5, the valuation debate. Is it priced for perfection? Let's neutrally lay out the dueling perspectives here on Wall Street. With the share price sitting right around $41.19, we have to weigh the bull case against the bear case. Now the bulls, they point directly to the cash flows. If you run a discounted cash flow analysis, it estimates a fair value of $54.38, meaning the stock is roughly 24% undervalued today. They absolutely love the net margin expanding to 16.2% and those multiple Phase 3 trial catalysts we talked about looming on the horizon. But the bears, they are definitely sounding the alarm. They warn that the stock trades at a really lofty 37.3 times price-to-earnings ratio. That is more than double the U.S. biotech industry average of 17.6. The bears point out that when you pay that kind of a premium, there is exactly zero room for execution errors, especially when you factor in macro inflation risks, plus this looming patent litigation trial they have against Sonic Healthcare coming up in early 2027.
And a primary concern highlighted by the analysts over at Simply Wall Street is this growth forecast right here. Despite that massive 166% trailing earnings growth we saw earlier, the long-term forecasted annual earnings growth going forward is modeled at just 8.6%. That actually trails the broader U.S. market average of 16.1%. Analysts are currently projecting a revenue target of $712.5 million by 2029, and frankly, some bears feel that this slower future growth rate just doesn't justify that hefty 37x earnings premium.
So the crucial point really is perfectly summarized by this quote from Simply Wall Street. They said, "To own Veracyte, you need to believe its genomic tests can keep expanding their clinical use and reimbursement support." In other words, investing your money here requires total faith that the upcoming Prosigna and TrueMRD launches won't just have great science behind them, but that Veracyte will successfully convince the big insurance payers to actually cover them widely, and that's never a guaranteed slam dunk.
Which brings us to our final provocative thought for today's explainer. Can Veracity's upcoming clinical data at ASCO genuinely justify its premium price tag? Or is the broader biotech market already pricing in a completely flawless execution? You definitely want to keep a very close eye on those phase 3 Optima trial results. Make sure to revisit those 5 fundamental valuation models we laid out. And as always, do your own deep fundamental research to see if this passes your personal investing checklist. Thanks so much for joining me today, and I'll catch you on the next explainer.